The price of oil is under pressure after a ceasefire was declared between the United States and Iran. But should investors continue to be expecting elevated energy prices going forward? Joining us now to discuss is Andriy Yastreb, VP and Director for Portfolio Research with TD Asset Management. Andriy, thanks for joining us. Big moves since we chatted about having you on the show. There's a big pullback in the price of crude. Let's get your reaction right away to what we're seeing in the markets.
Thank you for having me. Obviously, markets are reacting quite aggressively here. As a reminder, we started the year and oil was around $60, right? 60, 65. Then it moved to $70 roughly and above on expectations of potential conflict when some of the headlines were getting floated around. If you look at what happened yesterday, it was quite amazing. On this chart, it shows oil price for Brent, but there are two different prices. One is the actual spot price with immediate delivery, and the other one is, the yellow one is the futures price, which we usually look at as the headline number for oil, right? So the interesting part here is that the green line, it reached all-time highs yesterday. Oil went to $144 in spot markets, and that was all-time high. It was higher than in 2008, and that tells you that the market, the actual physical market, was getting really tight. The other interesting part is that the gap between the two lines was also at record high, so over $30 per barrel. Usually it's $1 or $2, not more than that. That tells you that the expectation in the actual futures market, and the name kind of implies that they're actually looking forward, they're looking into future. The futures market were thinking that this disruption is becoming so big, and the magnitude of it, if this continues, we go into recession, and hopefully something happens before we get to that point, right? So markets were expecting some kind of resolution before that, and that probably explains that most of that gap anyway. So since then, obviously today oil is down around 15%. It changes by a minute. But I think the market reaction, what that tells me is that we have confirmation that there is a diplomatic process behind the scenes. There is a negotiation behind the scenes. And B, we have a ceasefire for 2 weeks. That's positive. We'll see how it goes. We have a ceasefire agreement. Fire is still continuing. Hormuz is still closed, even though last night it was supposed to be open. There's still a lot of details to be worked out. But I think what market is thinking about this is that we have process in place and there's negotiation. Both parties agreed to this 2-week ceasefire. If they thought that after this fighting will continue and there's no room to make it peace deal, probably we wouldn't have a ceasefire in the first place. So that tells you that there's flexibility on both sides and rationality on both sides to get involved. And the final part of what I think is notable here is that apparently China got involved in the negotiations yesterday and put some pressure on Iran. And I think that's a positive, because if we stayed on the course where we were and Hormuz was mostly blocked, I think the economic implications would be severe and would hurt everybody, including China and all the emerging markets.
So if we can remain constructive here, we actually start seeing real moves towards some sort of peace during the ceasefire. You start getting the Strait reopened, oil starts normalizing. How long does it take before the globe starts to feel the benefits of that?
So here, there are several moving pieces, and there are a lot of unknowns, as you can imagine. So I'll try to break it down into different buckets, right? I think one bucket is that we have disruption to supply chain. And when you think about the oil market, the biggest part of the market is actually moving oil from Gulf to Asia, right? And a lot of that is done by VLCCs, which stands for very large crude carriers. So those are really big tankers, carry 2 million barrels a day. When you think about them, they were moving as shuttles back and forth. And that flow has been disrupted. And the interesting part there is that a lot of ports are not capable of handling those kind of ships. In the United States, there's only one port that can handle a fully loaded VLCC. In Europe, only a handful. So they were really designed to move oil between the Gulf and Asia. So when you put a stop on that, and some of the tankers are stuck in the Gulf, some of them offloaded their cargoes in Asia, you get to the point where the system is not working. And the average one-way journey for a lot of those destinations take 20 to 40 days. So I think there is a disruption that was getting to a point where it was becoming serious. From that perspective, 2 to 3 months, I think we'll get back to normal in terms of just the voyages between and the tankers becoming more efficient in moving oil around. Then the other part is how much oil has been shut down, and it's somewhere around 10 million barrels. Some say 9, some say 11, but around 10 million barrels, around 10% of global supply has been shut down. Usually it takes time to restart production from wells that have been shut in. For some of them it might take weeks, 4-6 weeks. For some of them it might take months. I would expect that within 3 months, majority of the production comes back online, as long as there is no serious damage to infrastructure. For some of them, it might take a bit longer, but I would expect from upstream oil production, getting oil from the ground perspective, within 6 months, we probably would be back to normal. And majority of that would happen within the first 2-3 months. And then the last piece and the biggest unknown is how much damage has been done to infrastructure and how long it's going to take to repair. Some of the infrastructure damage should be quite easy to repair. If there was a pipeline that was hit, you replace the steel. Some of the facilities are relatively easy. A lot of that is just steel that needs to be replaced, and that could have been done within a couple of months. For some other infrastructure equipment, and in particular refining equipment, more advanced equipment, and the worst, kind of more sophisticated and more complicated to repair part would be LNG equipment. That would take longer time. I think for refining, it would probably be months, within 2 to 6 months, I think. For LNG, it might take a couple of years. But again, some of the interesting things that we've seen in headlines this morning was, for example, Qatar was saying that they will be restarting their LNG facilities. So that means that Qataris have a lot of confidence that this ceasefire will lead to some positive outcome, and it's safe to start restarting those facilities.
All right, when we think about the energy complex, what does it mean for investors? I mean, we've seen, obviously, the stocks associated with natural gas, with oil, move quite a bit higher in the past little while. We got this big pullback in prices. How should investors be thinking about those actual stocks?
So in terms of stocks, it's going to be interesting. I think the usual playbook when you have geopolitical disruptions is that when you have a spike, you sell into it, and then from there, oil goes down and stocks follow. I hope that it's the base case here, and that's what's going to happen. But obviously, with what's happening on the ground, and there's so many moving pieces, we're not out of the woods yet, so we'll have to wait and see for the confirmation. I think my base case is that probably we've seen the highest peak of oil for this year, but that assumes that we move in the right direction in terms of negotiations. And then it becomes interesting in terms of oil versus stocks. If you look at what happened in 2022 when Russia invaded Ukraine, oil rallied to $120 or so, stayed there for a couple of months, then started coming down quite quickly. But oil stocks didn't move in line with oil. So there was a decoupling between stocks and oil. But back then, the driving force for that decoupling was the fact that after COVID, companies focused on paying down debt. And as they did that, especially with oil at $120, it really accelerated that transformation on the capital structure side. A lot of energy companies started to announce buybacks, increasing dividends, and that helped attract more investor money into the space. As we look at the space right now, I think most of the companies, they have their capital allocation frameworks on autopilot. So their buybacks will fluctuate to a degree with oil. And as oil comes down from this elevated level, I think stocks should follow more closely than in the past. And I think the other big question is, where do we actually finish the year, right? Like if I'm correct that within 6 months, majority of the damage can be repaired, and who knows, maybe part of the deal with Iran will be that there's no more sanctions on Iran and Iran can start growing production. Where does oil settle by end of the year? It's really hard to tell at this point, but my guess is somewhere around $70 to $80, and most energy stocks are already pricing that in. So my guess is that stocks will probably follow the commodity lower, and we've seen most of the returns in energy already being realized.